Well, I think the worst case scenario is, and the reason I worry about the U.S. stock market from this perspective is that for the last 20 years, we've had globalization, and half the margin expansion you've seen for S&P stocks has been attributable to open borders, tax arbitrage, labor arbitrage, just sort of taking advantage of global, price dynamics. And I think that value proposition comes to an end if we reverse that
right,
trend.
but it just sounds, see, with Alarian, he's leaving the possibility that the upside could be significant.
The upside to the U.S. economy specifically.
With the trade skirmish with China could end up ending 20 or 30 years of really getting the short end of the stick on intellectual property and everything else. In your view, it sounds like could be really bad if there's a trade war, but really not that good when we settle with very minor,
No, I mean, I think at some level it's a positive because we're leveling the playing
But it couldn't be a great positive? It couldn't be a sea change?
I think that one of the risks to U.S. stocks is that we've become a very global benchmark. The S&P 500 is the most global benchmark in the world, and it's more of a proxy for global growth rather than just
What
US
if all
growth?
tariffs came down? What if we went to zero everywhere? That wouldn't be a huge positive for global trade? Then that'd be even better for your thesis.
I mean, it would be, yeah, but I think that's a pretty unlikely scenario. I mean, again, never say never, but I think that where we're going now is just, the motivation for this is really protecting U.S. jobs. And I don't know if the way to do that is through, kind of forcing companies to manufacture within the U.S. and charging them more.
No, we need comparative advantage. I don't know if we'll get away from that. So, Thompson, I still think of you as, an earnings guy that, gives us, gives us your projection of earnings growth every quarter. So I want to ask you whether things are so good now that we start to worry about costs and margins and things like that yet, or we're still just let the good times roll.
Yeah, I mean, it's a lot of numbers, right? We're going to have 21% growth this quarter.
Oh, you're going to give me those numbers? 21%?
If you want me to.
Yeah, year over year.
I guess you should break the habit. I've been character rolled.
Yeah, you have. And your name is spelled differently than Thompson.
Yeah, but I don't even work for that company.
I know.
Thanks for giving them branding.
Yeah.
But the point is that you're going to see earnings start to get just the costs. Basically the comps are going to get more difficult the next couple of quarters. Look, it's more than that though. I mean, revenue growth is strong as long as you have a good macroeconomic backdrop, which we expect. You long have a measured 10-year rise. There's a lot of good news. I don't know in like 25 years when we've had this kind of environment. And, look, if you want to talk back to the trade war, what you do know about the market's getting callous. I don't want to say callous, but like everything else, it's starting to rationalize this. And I think, this is a long haul thing. I don't think it's going to be determined anytime soon. I think the market is going to do what it's done for Brexit. It's going to basically just digest it as it goes. And this could be years and years in the making. And the fact is it kind of plays a little bit to the U.S. is that, U.S. companies could, take a hit to margin because they do benefit. U.S. companies benefit, but one of the great things about the U.S. economy, and the S&P 500 represents this, it's really adaptive. So if they can't get the cost advantage in China, well, maybe it makes sense to have more jobs back in the U.S. Or maybe they go to places like Vietnam or other places. But that's the beauty of it. The challenges companies, and the U.S. Company is kind of built that way. So I think the market's taking it more and more in stride. And look, we're trading at 17.4 times next year's earnings. Yeah. That's pretty darn good. Now, that said, market gets a little bit more edgy. Once it gets north of 17.5, you get a little bit more volatility, and any kind of news can kind of send it in a little bit of a tizzy. But right now, I think it's hard to call a top to this market.
That's scary to hear, but it's not loved. It's not overly loved either, though, in terms of sentiment and.
Not at all. One thing we look at as a sentiment gauge is how we, Wall Street strategists, are allocating to equities and what we're recommending. Yeah. And strategists right now are recommending just basically a little bit more than half of your portfolio in stocks, despite the fact that we all know that interest rates at some point are going to go up and bonds are going to do badly. I mean, it's really the most tepid allocation we've seen after such a strong run in equities. It's really a hated bull market.
So sad that all the professionals, the only time you really use their sentiment is is to do the opposite. Isn't it the highest paid, the best you can get on Wall Street, and you use them just to do the opposite? It's terrible.
In aggregate, that's how you use it.
Also,
Exactly.
look at
Each individual one.
That's right.
But if all the individuals add up to bearish when they should be bullish and bullish when they should be bearish, I mean, what does that say? It's just
It says they're humans.
depressing.
Look at the quality of earnings. Look at balance sheets, corporate balance sheets. We're not going to have the kind of growth we've had in the last 2 years for the next 5 years, but we're going to have good growth for one good reason. We're solid. I think we're in much better shape financially. And I leave this to your people more than anybody else because this is your work. But I don't see any excesses in balance sheets. On the other hand, look at the amount of money that continues to be poured into these alternative investments, private equities. And this is the late stage. When LBOs, that's what they used to be called, started out 30 years ago, that was one thing. The market's been pretty well picked over, and yet money is still pouring into it. Why? Because there is a lot of money around, looking for a home, looking for some decent rate of return. So you look at stocks, 2.5%. I'm pretty happy, particularly if I can see 6, 7, 8, 9% a year growth. How big can that be? Doubles my dividend every 8 years, 9 years?
Right.
You'll never hear a word from me, and I think this is what we need to focus on with investors, and I assume in both your cases, that's what you got to look at. What's the alternative with my money?